Black here, founder of Acadian and the Race Summit, and I'm here with one of my favorite people in the world, an old friend, John Spinale. Hey, John, how you doing?
Hey Ben, great, thanks.
Welcome to the tipping point. Here we're sort of talking about the history and how great funds get started, and the story of Jazz Venture Partners is absolutely one of my favorite. Back before Raise was even in existence, John was asking me lots of questions about how to start a fund, and was a big part of the inspiration for bringing Raise together to begin with.
Yeah, I think I was one of those many irritating voices in your ear that was asking you the same questions over and over again. Like, how do you start one of these things? And I remember the day when you were like, "Hey, I think there's enough of you guys asking me these same questions over and over again. Maybe I should figure out a way to have broadcast these ideas and concepts and let you guys collaborate amongst yourselves." And so I remember when it all started.
Well, 500 funds later, Jazz Venture Partners has created one of the most impressive institutional platforms from a standing start to where you are today in all of venture capital. And it's been incredible to watch. You started way after me and then blew past me in AUM like I was standing still. So there's a little bit of jealousy with all that, I must admit, but happy investor. And John, I'd really like to hear about and to tell us a little bit about Jazz, and then go back to the earliest days about how you guys got started.
Yeah, sure. So it's kind of a fun story. So, ultimately, I was an entrepreneur, an operator for the previous 25 years of my career, and we kept bumping into these investments, and they really didn't fit into the regular mold of traditional VC. Like they were someone in like this interstitial area, somewhere between healthcare slash life sciences and tech, and I was helping to build and grow them and advise and invest personally. And I always joked like, hey, the world doesn't need yet another generalist VC fund out there. Yet at the same time, I saw that these things didn't have a natural home in the capital markets. And I kept bumping into a whole bunch of other people who were looking at these same companies and realizing they needed to exist, but they were actually struggling to get funding. And so we said, aha, I wonder if really what it takes is this interdisciplinary approach to be able to do these things, where you got people to collaborate from both sides and look at these opportunities. It looked like huge businesses, and it wasn't like these couldn't be great businesses. It's that they didn't actually fit the existing mold of VC. And so we had this aha moment, that that the world did need a specialty firm in this space, and my partners and I were all sort of circling these same ideas. And at that time, it was basically applied neuroscience, so understanding of the brain, the mind, human behavior, psychology meets technology. And now that we're bathed in technology 24/7, we're measured, monitored. Your speaker can talk to you. You connect to the worldwide web, all information at your fingertips at all times. That's going to change human behavior, and have a potentially positive impact on a whole bunch of different dimensions of life. So we saw this moment, but at the time, this is 7 years ago, so it sounded a little crazy. And so we found a bunch of like-minded, LPs who were more in the high net worth individual world, and they said, "I think you're right. Maybe the brain is the next platform." And then that's sort of what got the snowball going, and we invested in a few of these oddball companies that didn't really fit the mold. And then, fast forward a little bit of time, they didn't really look so crazy after all, and that's how the flywheel started.
All right, so you're making it sound kind of easy. First of all, did you know your partners well before? How did you all come together?
Um, so we have an odd partnership in a really good way, in as much as we pull together people that would never really be collaborating on the same platform. For instance, my partner Andy Furlick is a neurosurgeon turned venture capitalist, and has been investing in healthcare and med tech funds for much of his career. Another one was more in the medical device, invasive neurostimulation world. And then the fourth one was a big market maker and actually was running a conference ecosystem in related areas. And we realized that kind of like all of our skill sets were extremely complementary, and we needed one another to be able to go do this. If this thesis was going to work, we needed all of us to go do it. So we spent. I didn't know the three of them as well as they knew one another, but the four of us really kind of fell in love as we were essentially angel investing and advising each of the same companies, just kind of brought in through a different lens. And we realized this wasn't just a handful of companies that we could help build, but this was the beginning of an industry if our theory was right. And so, yeah, it definitely was a slog getting our first fund together for
Let's
sure.
talk about that. Let's dive into that. So,
Yeah, yeah.
day one, you say, okay, we're going to go do this. How did you, how long did it take you, and what did you do to get to your first close? If I remember correctly, it was a $150 million fund for Fund One ultimately.
120. And
120. Okay. See, I think it's even bigger than it was. Yeah,
yeah,
it
so
seemed very big to me. I was like, oh, that's pretty good. Yeah.
yeah, but it started off as 10. And and we continued to do rolling closes as people agreed and the portfolio built. Unfortunately, we didn't have any massive transactions happen during the fundraising process, which took us well over a year to get to our full target. And again, initially we were thinking a little bit smaller and didn't necessarily know that this whole thing was really going to hold together. But again, the more we actually started making investments and the more these companies looked real and the more the LP base got behind us, the more we realized, okay, I think there's a there. It's not only, is this going to be an industry and these are some great companies, but there's an ecosystem forming around it. So there's going to be follow-on capital and people who actually understand what we're doing. So we're not going to be just kind of out sitting alone in the field by ourselves.
So I remember from your original closes, because I would get the updates about who was coming in, that you had some very fancy people that were sort of thought leaders in the world, pretty early on, who agreed with you. And how did you find those people? And how did you sort of work with them and get to know them to the point where they would back you, a brand new team with a four-person that have never invested before? Only one guy has a track record, really,
Yeah.
right? So how did you get that first group together?
So I think we were fishing in the right pond, I'd say, firstly. And we had a lot of connections from our past lives so that we could get an audience with a lot of people. And the first people that really bit on it were people that could actually take had big family offices, usually out of the world of finance, many hedge fund managers, especially who had billions of AUM. They could invest in a thesis and a bunch of guys that seemed credible to go after it. Because if they're right, it's going to be good. And if they're not, those guys learned a lot for a couple $1 million tickets.
Yeah.
And what that enabled us to do is, again, plant a few stakes in the ground that then allowed us to actually show that this was real. Not only did four of us work together well, that this was actually going to be a real platform. And then it takes time to get institutional investors over the line. So that gave us enough essentially runway to be able to do the dance with the larger institutional guys. It ultimately ended up with Thematic coming in and anchoring our fund, but that took,
That was fun
better
one, or
part
was
of
that
2
fun two?
years.
I thought that was fun two. Was that
One.
fun one?
Yeah.
So that's a good one. That's a good one. Tell us about the experience with Tomasic. To the
Yeah,
extent
they are a phenomenal partner. They're definitely, very mission aligned with what we're doing. So we invest in human performance technology, how to make people better at all facets of life through these, digital interventions. And, they have a very, tightly run, well run ecosystem where they can actually materially invest in the future of Singapore. And so they saw what we're doing. They said, hey, if that works, that's actually going to be beneficial. A, it's a great investment thesis. B, it's going to be beneficial to our entire population here. They look at us through the health and wellness lens, but that's not exclusively what we do, but it's a big part of what we do. And so got to know those guys really well, saw the incredible alignment, and and they came on board.
And so you went pretty fast into Fund Two, and I haven't talked very much on this program about people you're doing Fund Twos, but talk about the transition and how you spun Fund Two together, and when did you decide to do it? What had you done at that point, and how did you manage that? Because your Fund Two was really institutional.
Yeah, no, I'd say we got lucky and we timed it well. We created a pretty concentrated portfolio for Fund One. It was 12 investments, each of which we had a pretty concentrated kind of ownership percentage of, and as a basket it looked really really good on paper. And actually, so our batting average was very high, but also the breakout potential for each of the companies still looked really good. And so we invested over about a 2 year, little over 2.5 year period, and built that portfolio, built our operating plan, the infrastructure around the firm, all this stuff that doesn't get a lot of airtime, but is actually really important to be able to do what you do. Tracking investments, connecting, building out the relationships in the network. So that by the time we had that basket of 12 investments, they were all looking really good. We could be referenced as a team as opposed to individual track records coming together. And we'd also been planting seeds with these larger institutional guys since the day we were born. And so by this point, we're 3 years into a conversation with, pension plans some sovereign wealth funds, and we're able to get many more of them over the line than you could whenever you're four guys with a great PowerPoint deck. So it was a long slog. So you could say fundraising in some cases took 5 years to do, because that's what planted the seeds for Fund 2 and then Fund 3.
And so, talk about some of the original. I think one of the interesting things that I think I say to people is, if you're going to do a thematic fund, you have to have a theme that sounds really exciting, because the theme does a lot of the selling, right? Like, and people have to believe in the theme, and you guys were pretty thematic, and yet the theme has to be big enough for there to be a significant multi-decade opportunity, And so, talk a little bit about some of those early ideas in Fund 1 that inspired the LPs, the institutional LPs, to take a bet on you guys.
Yeah, it's really funny. You bring up like that's the heart of the book. It's a double-edged sword. Everyone in the LP community says we want something that's differentiated, and so we bring them something that's differentiated, and then they go, "Wow, that's really different." And at the same time, they got their attention and got them to really take a look at it. And so, not fitting the mold can get you attention. It also can get you rounded out pretty quickly as well. So it's hitting that right balance where it's something that I can understand, even though it is different enough that it got me in the door. And as we built this differentiated product, then you have to have credibility. Like, is this a space that people are going to be really excited about? Is it going to be, like you said, big and persistent for a really long time, or is it really just a little niche? And we had that argument with people all over and over and over again too. In our case, it's like, hey, is this applied neuroscience meets technology going to be tiny, or is it going to be massive? And we would argue that it's massive. Where humanity crosses technology is a pretty big market opportunity. But whenever LPs hear something that's not again in the silos that they're typically investing in, they kind of put it in their head as a niche. Then you have to spend time explaining why this quote unquote niche is actually really a big, massive opportunity at the end. So it is a double-edged sword, but I think it's essential to get in the door, and actually get your airtime with LPs who are absolutely overwhelmed by funds that are whether existing funds coming back to them for more and more capital, or new funds hitting them up every single day. So it's the balancing act.
So now tell us where you are today. Where's Jazz today?
Yeah, so we've had an incredible ride. It's like I said, our first fund was a pretty concentrated portfolio that enabled us to get our second fund going, which is a little bit more diverse. We got to tune up the parameters in which we really wanted to optimize for return. So slightly more diversified portfolio, more investments, deeper ownership percentages. I'd say a little fewer board seats, to be honest, because it's definitely a little bit of the breaking point in Series A investing. A little bit more of a spread in terms of our ability to do a couple of seed deals and a couple of later stage deals, and really barbell it so that the returns profiles isn't quite as lumpy or deferred. That enabled us to then build a really phenomenal basket of companies in Fund 2 with all the deal flow and the credibility that we've built up in the first one, and then that allowed us to bootstrap right into Fund 3, which we're investing out of right now.
So looking back, I mean, you guys executed about as well as any firm I've ever seen. So I give you all the credit in the world. And
thank you.
And I would say that 4-person partnership, you get a lot more done. I'm curious, like, what percentage of your time as a group that you think in those first few years you were spending fundraising versus investing?
I bet you it was a 50-50, if not more, on the fundraising side of things. And it was incredible. And
I do not spend enough time fundraising, and that is like one thing I'm learning from all these conversations is I do not spend enough time fundraising.
So, okay. Percentage-wise, it was a lot, because we were selling a new story into a new LP base with a new group of people who hadn't worked together, as a team together before, and so it was a lot of time. But I think it was time well spent, in all honesty, because like those seeds that we planted that were no's, and we kissed a lot of frogs over the course of putting out our first fund. Actually, the seeds that we planted came back around in Fund 2 and Fund 3, and relationships that had developed over now 5, 6, 7 years in some cases. And so I would say I thought at the time it was highly inefficient and not terribly productive. But on the flip side, now that I actually look at it in hindsight, I say it was time incredibly well spent, and have
That's a great
you know,
perspective.
a large fraction of your time, you know, dedicated towards, you know, firm development, fund development, and LP relationship building.
So tell me, like, looking back on it, if somebody was starting today, and they wanted to create a fund, a new VC fund, and you know the VC world now, you've been in it for 7 years, you've been around it for 20 something. What advice would you give them?
Well, it's a really good one. You know, firstly, we were blessed by having, you know, a really, really differentiated product in a space that was taking off, and a partnership that, you know, really added up on paper to be able to go do that. And I'd say it, at whatever scale you're doing, that is the recipe that works still to this day, right? It's the you have to have something that genuinely stands out in terms of an investment thesis, and whether that's a geography or a space or a pool of entrepreneurs that you have unique access to. Um, and then some way to actually show, especially if you come, I'd say, from the operating world, like many of us did at my fund, the ability to show that your operating skills actually and the networks you built matter in the field that you're doing, but also that you can actually really be an investor, and take off the operating hat and think about this business as its own unique thing, which it really is. And I'd say going through a lot of the dances with LPs and the scrubs and the grinds, both of those sides were equally well tested over the course of building this thing out. And I think, you know, those were all really, really great hurdles we had to go through that made us better at what we do. Um, but yeah, figure out how to stand out from the crowd is number one.
All right. Well, thank you, John. We really appreciate it.
Hey,
Been
my
great
pleasure.
chatting
Fun
with
is calling my day. So thanks for having me.
you. I'll talk to you soon.
See you, Ben.